Imsirovic, Senior Research Fellow at the Oxford Institute for Energy Studies, and Chris Wood, CEO of Savanara. Thank you very much, gentlemen, for joining us this morning. Adi, if I could go to you first, please, and let's address a topic that we've been all talking about the last week or two, which is the gas crisis, gas price spike crisis, particularly being felt in Europe and Asia. And let's just start with Asia there, just to ask you, a lot of the Asian utilities are obviously considering already, switching from gas to fueling their utilities with oil and coal, more coal, let's say, to a certain extent. And could you argue that Asia has the flexibility to do that because of policies on emissions, if you like, but Europe is kind of stuck because of its restrictions on that front. So how much is this gas crisis going to impact demand in those two regions, respectively, in the next few months?
Well, thank you, and it's a pleasure to be here with you, Dylan. I think a lot's been said about the gas crisis. I mean, it certainly has been a perfect storm. Asia is very interesting because Asia is the growing market. Europe is less interesting simply because there's always been a gas sink. So all the sort of surplus was, simply going to Europe because it's a very liquid market with sort of good storage and actually good contracts like TTF and MBP, where you could just sell any surplus gas in terms of futures and later delivery. Asia's been growing significantly and has been outbidding Europe in terms of gas prices. China in particular. I think I read somewhere yesterday that China has been adding like about 15 million customers sort of regularly on every year to the gas grid, which is equivalent to Holland and Belgium put together. So that demand has just been absolutely staggering. And of course, China has been trying very hard also to sort of meet their environmental goals. And not just that, I think even more importantly, in China, from the political point of view, meeting the sort of air quality standards has been extremely important. And that's why there's been this switching away from coal. So as
at the moment, not. I mean, they're very clearly saying, let's pump as much coal out as we can for the time being.
Well, there are simple economics. You can't beat economics. If it's much cheaper to burn domestic coal, so be it. Now, at the moment, it's very hard as well because they've had flooding, a lot of flooding, and coal mines have been shutting. So I think China is also facing a perfect storm as well in many ways as Europe. So, and at the same time, Europe has very much different drivers, I think, because it has been a sink and Europe's been on the forefront of the sort of green energy transition. And in many ways, we have sort of put emphasis on gas. So while sort of gas emissions in Europe have been a problem, in Asia, they've been a solution. But of course, gas has been a victim of its own success. Simply, demand has been outstripping supply because gas has been seen as sort of that bridging fuel that would very quickly sort of bring you to a lower gas emissions. And that explains the prices. Of course, it has been perfect storm because of the weather as well. We've had a very cold and late winter. I'm now talking a little bit about Europe where I know better. So we've basically drawn our stocks. And then we had extremely hot summer, which again required a lot of power. And in Europe, gas has been sort of main sort of spinning capacity for power, especially in the UK. So where we've really pretty much got rid of coal and just moved to gas. But
well, let me just stop there, Chris. Just to go to you on the same theme of gas. Yes, we're having these spikes in demand because of cold weather, because of seasonal conditions, but that's always going to be the case. And many people are saying, as with oil to an extent, but more so with gas, that there's been really a huge underinvestment in gas, generally speaking. And that's really what's triggering the problem right now. It's not just spikes in demand, but that this is going to be with us for a while. We were not prepared.
Well, to me, there's a couple of things that are driving the current gas price where it is. One is, as you rightly say, is underinvestment for years. And going back to Adi's comment about simple economics, gas price was so low for such a long time that even Shell, when it launched its Australian LNG project, sort of sat there going, oh, are we ever going to see returns on this? Now, where gas has suddenly gone through the roof because people are stocking, and in some cases overstocking because of the fear of what could come this winter, and that's a perception element, as well as there's been some shortages, and I'm not sure it's all down to Gazprom. I think the politicians put a bit too much on that. So what that leaves is all the short consumers like China, like Japan, possibly India, then looking for other solutions. Well, how are we going to fill this? Because we're not going to pay $8 for gas, because that's going to push our energy-intensive industries out of the market and not make them competitive globally, and therefore we won't be able to compete on the global stage on general production of goods and materials. So I think from that point of view, those short customers are very much caught in the headlights of, well, what do we do? Drive the gas price up, because those that can afford it, like Japan, will do, and stock up and make sure that people don't go cold over winter.
Carry on. Yeah.
Or switch to alternative fuels, which is why we're seeing this resurgence in coal and even oil to some extent, where there are still those oil-fired power stations, coal-fired stations that can come out of mothball situations and fire up and keep the prices more realistic, then they will do.
Yeah, and let's talk a bit about oil, because obviously a lot of the support that's underwriting the price at the moment there on the oil markets, a lot of it is being attributed to this current gas situation, rather than sort of specific oil fundamentals, if you like, on their own. How much of a solution can oil supply provide at the moment to this shortage, if you like, of gas or high-priced gas situation? From an OPEC supply point of view and oil supply point of view, now how confident can the market be that oil will be made available if it's needed?
Good question. So one thing is availability of oil in the right place, no less. But it's mostly developing economies that still have the capacity to use oil as a power generation, and not those of the US or Europe and even Australia. They've decommissioned all the oil-fired power stations to most extent. So I don't think it's going to fully sort those issues out, but it will certainly help alleviate the problem in some of the developing countries, assuming they can get the oil, not just get it, but get it to the right place economically to compete. But at the same time, I was just looking at just before we joined, the share prices of the oil majors. Now suddenly the oil majors are very good investors again, and BP, Exxon are all climbing up, and people are interested because clearly they're going to have good returns, good dividend payments if the oil continues to climb up the way it is and the demand continues to go. So if you remember, all the oil majors prices dropped with all the push for renewables and that. I guess on the plus side, all those majors that have said we're going to invest in renewables and developments now have the cash to do that.
So they'll probably follow that twin trajectory, if you like. Narendra, good morning again.
Good morning.
Let's talk about the healthy oil price situation for majors and for oil producers. Not so healthy or good for India, obviously. How is the thinking today about $80 oil being absorbed, and how much worry is there about how that's going to impact India's economic recovery from COVID?
Well, higher oil prices are always a bad news for countries like India, since our dependence on imports is very, very high, close to 86%. And at the same time, when you look at Indian economy is recovering fast from the pandemic, and demand for petroleum products is on the rise. Petrol, for instance, already back to normal. In fact, is more than what we were consuming, let's say, before the COVID. And diesel is also getting there very fast. Diesel demand is also growing, but not as as steadily as petrol. And the turbine fuel, where India sky is opening up, people started traveling and all that. So demand for ATF is also going up, and the LPG cooking food is also going up. So overall picture is that the demand is steadily growing, and at the same time prices are going up. If you compare with September last year, prices have gone up by almost 105%, which is a very, very bad news for the Indian consumer. So right now, the hottest political issue in India is petroleum prices. though petrol and diesel are decontrolled by the government doesn't control the prices anymore, which it used to, but it's still the people look at the government. So you got to intervene, you got to do something about it, cut your taxes, or talk with OPEC, talk with Russia, talk with Saudi Arabia, and so on and so forth. So
Yeah.
So higher oil price is bad news. We're keeping our finger crossed, and one hopes that the good sense will prevail. Otherwise, economies like India will need to invest even more in renewables so that we can bring down our dependence on oil to the extent possible. But that's not something that can happen overnight. That will take years.
Adi, on the OPEC front side, they clearly took their decision a couple of weeks ago to keep things as is, i.e. keep this current plan as it stands and not add more oil than they were planning to. At what point will OPEC perhaps change that plan to increase more supply? It can do. It's got 5 million barrels a day of extra capacity today.
Of course they can. OPEC Plus actually more likely is in a pretty difficult position, because every time they decide they want to supply more oil to the market, there's a setback from the COVID. Let's not forget, we're still in that COVID situation. And as we saw, for example, in August, market was, looking quite weak again, because we had, this third or fourth wave, whatever it was, and sort of all the sort of travel plans were dropped and so on.
Sorry to interrupt you there. Just given that OPEC can change from month to month what it's doing, which is exactly what it's been doing really, in terms of meeting and telling the market it can do that. The COVID excuse, we've talked to a lot of people in the last week, that is just you just can't get away with that anymore, at least for now, at least for the next quarter, for the next 6 months. And if it comes back, let them readjust. That's no longer being absorbed as a viable excuse for putting off, for being cautious.
I'm not sure I agree with you there, because they do meet month to month, but let's not forget that their nominations, for example, Saudi nominations and most of the Gulf country nominations are done 2 months in advance. So, they have to make those nominations so early that they have to plan ahead, 2 months ahead at least. So they do have a limited ability. But let's not forget, look, they've increased roughly 400,000 barrels additional crude. But if you actually see the loading, Saudis have actually in September increased. They've given full nominations basically to their customers. So their increase is going to be about 650. So they do have that discretion to supply additional volumes. And they do have to have that discretion simply because a number of countries within OPEC Plus have had problems even meeting their own quotas, like Nigeria, Kazakhstan, Angola, and so on and so forth. So as far as OPEC, that's a kind of current situation. But they do have still, as you rightly say, at least 4.5 million barrels of excess capacity they can supply to the market. And I think you will see that at these current levels slowly coming to a head, even though their compliance, the last number I have is August, was about 115%. I think you're going to see, we're already seeing on the water, Russian exports picking up quite significantly, for example.
And I mean, Chris, just to go to you on that point of OPEC supply and OPEC Plus supply, today, yes, there are certain members who are not able to even meet the current quotas, but fast forward 6 months from now, and you're going to have potentially a lot of those members being able to meet the current quotas. You'll have Iran. Where are we on the Iran equation? In 6 months' time, do you expect that we will have Iranian crude back? And is that why today those who are part of the supply equation are making the most of it? Oh, you've gone on mute, Chris. Sorry, if you need to unmute yourself.
Yeah,
thank you.
there we go. Possibly the Iranian issue is down to politics at the moment, and when the politics sorts itself out one way or another, then you'll see those barrels come back onto the market. Will it make a massive impact? Probably not too much, as we were talking about. There's enough demand in there. OPEC will readjust its figures to suit. The other thing is we're starting to see that uptick in demand coming in post-COVID. This COVID discussion starts to slip away a bit on how much impact and just on that point, I've never seen an industry create so much data in such a short amount of time, so we can know exactly how many cases, how many recoveries, and that it's the oil industry could take a lot of lessons from this and figure out how they can get data that quickly. But from that point of view, I think there's a couple of things I've noticed. The sort of refining uptick in the US, so we've seen a slight increase in refining capacity. They're still 5 million barrels delta from their own production versus import, so they're pulling in barrels from elsewhere. So that's going to have an impact in where they pull those barrels in from, depending on what sort of products and pricing is achieved in the market. Asia, clearly, it hopefully will start to come back to normality, and we're seeing the opening up. This morning, I saw a headline around Singapore Airlines crashing their website because there's so much demand for tickets, and so we will start to see an increase in that capacity and that demand. OPEC is going to need to seriously think about its targets for the rest of the year, I think, even though it does have a delayed effect.
And of course, a recovery in jet fuel finally, because of it, especially if Asian skies are opening up. That's obviously spiked a couple of weeks ago, but an expected continuation of that recovery finally. It was lagging behind everything else. Narendra, just back to you. Let's talk a little bit more macro economy. India's Reserve Bank Monetary Policy Committee last week, I believe, they left rates unchanged. The whole discussion now is, when are interest rates going to increase across the world, really? When and by how much, actually, not so much when. India left them unchanged. However, you are, like other parts of the world, expecting inflationary pressure in your economy. I believe the projections are currently about 5%. So what do you expect the central bank to start taking any sort of hawkish restrictive measures?
Well, good question. Very difficult to predict, but probably nothing before Christmas, I suspect. And when it comes to inflationary pressures, the actually bulk of that is coming from higher diesel prices, because Indian economy is, by and large, broadly speaking, is a diesel economy. We consume so much of diesel. And with diesel prices going up all the time, crude oil prices going up all the time, is building up tremendous, pressure on the economy, especially when in terms of inflation, because practically everything that moves in India is using diesel, and gas is increasingly playing an important role, but it's still diesel across the country. So, but overall, the good sign is that economy is improving. People are coming back to work. Factories are back to 3, shifts in a day, and people have started flying. And so overall sentiments across the country, malls are full of people, streets are full of traffic. Even a new airline yesterday, a big investor announced launch a new airline, and so which is a very very good news overall. Is if you look at it, but my own sense is that at the same time, if crude oil prices keep moving up in the northwardly direction, I think that's a bad news for economies, particularly like India, because it plays such an important role. Of course, in terms of inflation, and secondly, also on hard currency reserves and overall, the fiscal deficit of the government.
Yeah,
so therefore.
Yeah. So on your debt problem, the fiscal deficit and the debt issue. I mean, what is the current thinking of how to handle that going forward?
Well, you see, of course, if you look at it, from the as an economist, the solution is only to expand the economy and make sure that people are borrowing money, and respective companies are trying to respect their full potential. So that exactly is precisely the focus, with focus more on medium to small size companies. So overall, my sense, the sentiments are very good. But I think India needs to talk with Saudi Arabia and Russia and other countries, together with China and other big Asian importers like Japan and Korea, to talk with these oil producers. Otherwise, I think otherwise things are going to be a little bit more difficult for India than, let's say, with China and Japan, since we are more vulnerable than China, because our dependence is so much more than China. But that said, at the same time, I think my sense is that when it comes to OPEC, I think if the oil prices in the region of 70, that's a win-win for OPEC, but at the same time, countries like India would not be complaining too much. But if it goes anything more than $70 per barrel, I think then the matter will go up even at the level of G20 and bilateral discussions, so on and so forth. Because anything more than $70 is a terribly bad news for economies like India.
Okay, well, we're already at 80, and the projections are that for the next 12 months, that sounds like it's going to be a minimum.
Unfortunately.
From what certain forecasters have said in the last few weeks. Adi, we just had our survey question up there. Do producers want to see $100 oil? I mean, we've talked about when OPEC will step in to prevent that maybe from happening, but is that in anyone's interest, considering the impact on consumers, obviously?
When it comes to the sort of long-term sort of producers with the sort of long-term time horizons such as that Saudis, it doesn't. $100 oil is not a good thing, especially at the time of energy transition. I think Chris mentioned earlier on that it's certainly going to speed up transition at these high gas and oil prices. But let's face it, they've had a rough time since 2014, and they're probably secretly quite happy to see their coffers, getting filled up with cash, badly needed cash. So, but personally, I actually hear the institute. We were doing some work purely from the balancing point of view. We're not as bullish the oil prices as some banks, like namely Goldman Sachs, for a number of reasons. As Narendra mentioned, India has been very disappointing this year. I think we see growth this year of not more than maybe 300,000 barrels, and next year not more than 500,000 barrels. So it's not going to contribute much to the market. China is, as we all know, facing some headwinds, especially with the property market. They in the worst case scenario, they could see the subprime situation in sort of hopefully not, but we do see the government trying to cool down the property sector. Because of shortages of power, floods, and so on. I read some numbers that in Q4, China could see industrial production fall by as much as 12%. So none of that is looking very, very bullish in terms of overall demand. At the same time, while this year on average we were drawing stocks to about 1 million barrels a day, for next year we certainly see a very different situation. We see sort of a return of U.S. shale production, primarily from Permian, at close to 1 million barrels, about 800,000 barrels a day, and surplus for the whole year. Next year we see of 1.8 million barrels a day. So, from pure balancing point of view, we're not that bullish. Now, of course, you guys covered very well the sort of the story of inflation. We mentioned macro and so on. So obviously those, with all the commodities picking up, and I think recently we've seen all the industrial commodities like zinc and so on picking up over 3%, oil will probably look fairly supportive, and we could see blips well above $80.
Narendra, just to go, and I wanted to go back to Chris on to talk about LNG, but Narendra, just on that subject of inflation, we talked. There you go. Oh, that's a high number, right? 78% oil producers would people think they'd like to see it. That's contrary to some views I've heard recently. Narendra, on the subject of inflation, there's the argument being made by many economists that, oh, well, the world's been saying it needs inflation for the last 10 years, and now we've got it. Is it somehow a healthy thing to have that, even as a consumer of products?
No, not in case of India. Our economy is quite different in terms of its very fundamentals and characteristics. I mean, we need we're trying to our best to push demand, and we still have a large number of people who are very, very conservative when it comes to spending money. And there is also a small percentage of people, they just don't have money. So therefore, in India, it's very important, that, we look at very differently, and our economy is largely, driven by domestic demand and not by, exports or imports and so on and so forth. So therefore, it's a very different economy, and Indian economy in terms of characteristics and features cannot be compared with any economy of the world, most particularly the large economies. Therefore, our issues are very different. That's what precisely I was trying to say. We are basically facing challenges from two sides. On the one side, some banks, particularly, they are saying oil prices will go up to $100 per barrel, in 16 months or 17 months, which is terribly bad news for India. At the same time, we see, Glasgow summit is coming. And if the narrative there, promoted by the rich countries, that look, oil is dirty, demonize oil further. And that means, the oil prices investment will slow down. And we have already seen investment from private, sovereign funds and all that in rich country. They have stopped investing in oil companies, even in oil companies in India, like the Norwegian sovereign fund has withdrawn from Indian oil company completely. They've taken out every single cent. That's not a good news, not a happy situation. So the result could be that after Glasgow, probably there's going to be more pressure on, so-called super majors, private super majors, which means that actually everything will then shift to only publicly owned oil companies, mainly OPEC. That means OPEC plus, like Russia and other. And that probably would create a very different situation. That means the government will come back to the cockpit and they will be using oil for politics, oil for bilateral relations, oil for every kind of thing. So that is going to be very, very difficult. It will be like back to the 1980s and 90s. And that's a scary picture in the sense where markets would be more or less out, private investors will be more or less out, and everything will be then OPEC plus and petroleum minister. They will become the most powerful. So for economies like India, which is so heavily dependent on imports, oil import, that's a very, very, that's why we want in Glasgow that they should understand energy crisis is real, climate crisis is real, but at the same time, transition will depend on from geography to geography. And in geography like India is going to take a long time. And we hope that, the climate czars and those people who, even those who are like promoting radical environmentalism would understand. Yes, it's very important. Climate is the issue, absolutely no doubt about it. But if you think of climate minus energy, you will only end up giving miseries to millions and millions of people across the world.
Yeah. Chris, just to talk about how important the immediate access to energy is, and short-term versus long-term objectives of the global economy, if you like. We've had supply chain issues, bottlenecks, as kind of trickle through from COVID and onwards, and now this sort of surge in pent-up demand, et cetera, and inflation, goods, commodities, because of bottlenecks, perhaps rather than real supply problems. How much of an issue is this still? I mean, do you see that resolving, clearing out, if you like, by the first quarter of next year? And we just have to be patient for now for these spikes, and that everything will be back to normal.
Yeah, no, I'll do an Omar. Back earlier this year, I made a comment, probably a bit flippant at the time, where I said, start buying your Christmas presents now because there's going to be supply chain disruptions and you won't be able to. There'll be shortages come Christmas time, and COVID has led to some of those supply chain disruptions. There's been storms, weather patterns that have had significant impacts to others. And what you see in a typical supply chain is when you have inelastic demand and it's sort of going up and down, and also should I say elastic demand, you're starting to see the amplitude in the supply chain get bigger and bigger, which means that you don't have a consistent sort of steady stream supply chain. Ships are in the wrong place, boxes are in the wrong place. So this starts to affect availability. It starts to affect the issues where we're seeing where it's perceived shortages. We saw it in the UK where they're panic buying on the forecourt, and that was purely down to the amplitude in the supply chain. Suddenly, one side of it getting a bit out of kilter with the other. So I don't see it sort of tidying up anytime soon until we can start to smooth out that sort of demand and supply side of things, not just in the oil industry and not just in the gas industry, across the whole piece. Then I think we're going to have these troubles for some time. And I'm shocked by the poll results of sort of driving towards $100 a barrel. It's sort of my personal view is anything over $75 a barrel is not good for global economy, because it's taking money out of the wrong places. You have working capital that's sitting there not doing much value add. You've got people that are having margin calls. You've got developing countries having to pay huge bills for just day-to-day activities. So I think the winner out of that will be the resurgence. I think Adi said the resurgence of shale oil, because if the higher prices come back, then it makes it interesting to invest back in that patch.
Well, Adi, I'll let you have the last word. I mean, on shale oil, the speakers we've had on the program the last week have mostly said, nothing's going to shift much on that front, regardless of prices. It's just there is going to be too much capacity in the system anyway in the next few months, and shale oil just will not make the difference in that. But just to wrap up and go to you for your, just zero in a bit on the UK, again, sticking with this inflationary argument, wage inflation, cost inflation, debt. We've had a couple of warnings from the Bank of England and others this week saying that, not sorry, the Bank of England, others about what the Bank of England might do, saying that, some of the companies are in real trouble, over leveraged, everybody sort of over borrowed, obviously we're given cash in COVID. How serious is the situation for that, for corporates? And, how do you expect to see any impact of that in the earnings results that we're going to be getting over the next month?
Well, I don't see a big impact on the earning results this shortly, because the economy is still doing very well, even though we see some evidence. I think this morning on BBC website there was an article about British consumers being rather careful now in their spending because of these supply issues. They're basically sticking to their sort of basics and leaving some money for a rainy day. But overall, Yala, we have spent so much money that we don't have because of COVID, that inflation, that again, old topic we've been discussing today and previously GI has been discussing it, is probably quite frankly the only way we can get out of this debt situation. There's simply no way we can tax our way out of this current situation. And that's one factor that will generally be supportive of the oil prices purely from the macro and financials point of view, because most of the funds are adding oil to their portfolio simply as a means of protection against inflation. So that's supportive, even though, we're seeing, the balance is actually being quite okay. Going back to your point in the US, actually, we disagree. I think Permian is definitely coming back. It's just taking us some time. What we've seen is recently some consolidation. That consolidation has been the main reason why the companies didn't rush. It wasn't as perfect market as it used to be. And managers are quite happy to pay themselves sort of higher bonuses through share options by buying back those shares. The old sort of a game of big companies. But overall, I think the big story is I think, and a big takeaway out of this energy crisis is probably this supply crunch, because most of the policies dealing with the energy transitions have been on the supply side. So pressure's been on Shells and Exxons and so on, and no wonder we see these really high prices. Instead, there's been very little pressure on the demand side. Even the United States and Biden's administration is bulking away from using carbon tax, for example. So when you have this imbalance in economic policy, where everything is on the supply side and very little on the demand side, in fact, in Europe and in the UK, we have gas is capped, the prices are capped for the residential sector. We have subsidized VAT. In most countries in Europe as well, the domestic prices, the retail prices are protected. We've got this high demand, and all the efforts in terms of green transitions are on the supply side. And until we balance our policies, I think we're going to see this very difficult situation of high energy prices.
Okay, well, thank you, Adi Imsirovic, Chris Wood, and Narendra Taneja. I'm afraid we've gone over time, not just run out of time. Thank you very much for joining us this morning, and look forward to seeing you again very soon. Thank you to our viewers, and we'll see you again tomorrow morning. Thank you.